Think of capital structure as the recipe a company uses to fund itself. The mix of debt, loans, and bonds, and equity, shares, that keeps the business running and growing. It's not a one-time decision, but an ongoing balancing act. Debt can be cheaper and tax advantageous, while equity is safer and more flexible. So what's at stake? Debt gives you leverage. Borrowing can lower your overall cost of capital because interest is tax deductible, and debt holders generally accept lower returns than equity holders. But too much debt raises the risk of financial distress and bankruptcy, which can be costly. Equity doesn't force cash outflows, so it's safer during downturns, yet it's usually more expensive because shareholders demand higher returns for taking on residual risk. A few simple measures help you judge a company's structure. Debt to equity ratio, how much debt for every dollar of equity. Debt ratio, proportion of assets financed by debt. Interest coverage ratio, how easily operating income covers interest payments. WACC, weighted average cost of capital. The average return the firm needs to pay its providers of capital. It's roughly EV/RE plus DV/RD, 1 tax rate. Why does this matter? Capital structure affects a company's risk profile, the return on equity, investment decisions, and ultimately value. If you add low-cost debt sensibly, you can reduce WACC and increase firm value up to a point. Past that point, the rising probability and cost of financial distress negate the benefits. There are a few ways academics and practitioners think about the right mix. Trade-off theory. Firms balance tax benefits of debt against bankruptcy and agency costs to reach an optimal level. Pecking order theory. Firms prefer internal funds first, debt second, equity only when necessary, because issuing equity can signal overvaluation and is costly. Market timing theory. Managers take advantage of market conditions, issue equity when prices are high, borrow when rates are low. Practical factors that shape capital structure. Cash flow stability. Predictable cash flows support higher leverage. Asset tangibility. Tangible assets like real estate can be collateral, making debt cheaper. Growth opportunities. High-growth firms prefer equity to avoid forcing projects to meet fixed debt payments. Industry norms. Utilities often carry more debt than tech startups. Tax environment and interest rates. Covenants and investor preferences. Stage of company life cycle. Startups rely more on equity. Mature firms can handle more debt. A couple of quick examples to build intuition. If a business borrows at a low fixed rate and has steady cash flows, a bit of debt can boost returns to shareholders, higher ROE. But if revenue is volatile, those fixed interest payments can squeeze cash and force asset sales or even default. For managers, think in terms of ranges and triggers rather than a single perfect ratio. Set target ranges for leverage, monitor interest coverage and maturities, and stress test for downturns. Be mindful of signaling when you issue new equity or debt. And remember, optimal capital structure isn't static. Adjust it as your business, markets, and tax rules change. In short, capital structure is about trade-offs: cost versus risk, flexibility versus discipline. Get that balance right for your business context, and you'll lower your cost of capital and make better value-enhancing financing choices.